So next up this morning, we have a presentation from one of South Africa's largest gold companies. And we have CEO Venkat here to talk to us about the story. So I'll let him take it away.
It's the green button, right? It's the green button. Morning, everyone. Today, I'd like to provide you with an overview of AngloGold Ashanti, our strategy and capital allocation philosophy, and the progress we are making in terms of reinvesting in the improvement of our portfolio. Our strategy remains a clear guide in how we manage the business with the aim of improved and sustainable cash flow and returns. And you'll recall that this strategy is supported by 5 business objectives. First, a priority on people, safety and environmental stewardship. Second, ensuring a solid balance sheet to sustain the business. Third, ongoing optimization of all of our expenditures. Fourth, continual improvement in terms of our portfolio. And finally, maintaining a pipeline of long-term options so that we are not forced to make bad M&A decisions. We have made tangible progress in each area. We have broken records in safety and environmental stewardship that we would have thought previously as being impossible. For 4 consecutive years, we have improved cash generation and met or beaten annual guidance, not just on production, but also on capital and cost targets. And importantly, using only self-help measures, I emphasize only self-help measures, we have restructured our balance sheet and at the same time self-funded our current reinvestment program, which is on track and on schedule. We are also investing in our best-in-class exploration program and operational excellence, which continue to unearth options to fill our pipeline in both the near, medium, and long term. In terms of our North Star, we have a clear capital allocation philosophy. This is how we deploy the funds that are entrusted to us. Underpinning all of these decisions is a prudent approach to our balance sheet, ensuring that we retain flexibility to fund the investments and weather volatile gold price and currency environments. To start with, we're looking for real risk-adjusted returns of 15% or higher. We use $1,100 per ounce for reserves and a conservative set of planning assumptions that provide a buffer to weather inevitable gold price and currency shocks. When deciding which assets are allocated capital, we favor our better, more consistent performers, and we also lean heavily towards brownfields projects, where we can leverage off our existing capital base for higher returns and quicker payback. In looking at our portfolio, you will always see us prioritize margins and returns over volumes, regardless of the gold price. And importantly, dividends are assigned before our growth capital gets allocated. There is significant activity underway across our international portfolio, as we flagged a year ago, particularly in extending lives in our key assets, whilst also selectively investing in improving margins and bringing in incremental production growth at better than our average cost. South Africa, on the other hand, represents a slightly different proposition, where we are investing just under 40 million after-tax dollars to restructure our production base by this year end. As we execute on this year's inward investment program, you'll recall that we flagged a spike in our sustaining capital expenditures. Given that the returns in each of these projects are all comfortably above our target range, we are prepared to sacrifice the immediate cash flow this year in return for portfolio improvements that will create value in the medium and longer term. As mentioned, there are some non-recurring items of sustaining capital expenditure of around $150 million this year. So we anticipate next year's sustaining capital coming down to levels seen somewhere between 2016 and 17 as we work through the plans currently. When this reduction is taken in tandem with improved cost at some of our key assets, for example, South Africa and Kibali, we anticipate better cash flow outcomes next year. Now, looking briefly at some of our key metrics. We are the world's largest emerging market gold producer. That means it comes with experience, not only in the cyclical nature of the commodity markets, but also in weathering the ebbs and flows of political challenges that we are forced to deal with each year. Managing through the inevitable increase of risk at various times takes a mix of patience, diplomacy, and steadfastness, and we continue to employ all of these. Of course, we also benefit from the breadth and diversity of our portfolio. Whilst there is desire from some quarters to see simpler production bases, we believe there is also merit in not having all of our eggs in one basket. And finally, we have a deep bench of technical and sustainability skills and an enviable track record in terms of project execution. This is quite an important slide. A quick look at our improving balance of our portfolio between international and South Africa shows greater dominance in our international asset base. This will continue to accelerate further as we remove loss-making South African assets from the portfolio this year. You'll notice that after a swift correction from a poor Q1 performance in South Africa, we have managed to get to a point where we can maintain our all-in sustaining cost guidance for the year at between $1,050 and $1,100 an ounce. Bear in mind what I said a moment ago, that it is in a year where we have elevated sustaining capital spend. That means even as we put our money to work in improving the portfolio, we have managed to preserve a healthy cash margin. You'll also see that we have managed to contain our cash costs this year, notwithstanding the sharp correction that we have seen in the local currency basket. I'd like to spend some time on safety, which is and will remain our highest priority. As you can see, we have bounced back from a very difficult start last year to a clean slate in our South African assets, almost taking us to a year as at 30th of June without a workplace fatality. In fact, every one of our South African mines have gone a year fatal-free. Each of our operations has carried its own weight, with our South African mines all exceeding 1 million fatality-free shifts. Moab Kotsong, the world's deepest single-drop shaft at close to 3 kilometers below surface, has gone close to 2 years without a fatal accident. We are proud of these achievements, but we are not celebrating these given how fragile these accomplishments can be in any type of heavy industry such as ours. To wrap up our high-level overview of metrics, our balance sheet is in good shape with diverse and ample liquidity, significant headroom, and no bond maturities until 2020. Now focusing on some of the improvements we are making to our portfolio. As I mentioned, we recovered well from a poor start to the year in South Africa with a 20% production rebound in the second quarter. Structurally, however, we did flag that there is a need to resolve some very old high-cost mines in our portfolio, namely Kopanang and Tautona. We are in advanced stages of finalizing the work to potentially sell Kopanang and place Tautona on care and maintenance. We hope to wrap that by the year end, with consequential overhead and footprint reductions to follow early next year. This process will reduce our South African production by around 200,000 loss-making ounces and our workforce in-country by roughly a third. What will emerge during 2018 is a smaller, simpler, and more cash-generative South African base that consumes less capital and is focused around 3 key assets, namely our long-life Impanang and tailings treatment businesses and the medium-life Moab Kotsong mine. Moving on to our more dominant international portfolio, we have a raft of self-funded work on the go to improve life and margins at our key assets. In fact, We have held to that self-funding model since the last equity issue we did far back as 2010, 7 years ago, which was dedicated to extinguish the legacy hedge book. The operations have funded all of the improvements over that period. We're seeing very good results with respect to our life extension objectives, notably in Australia, in Guinea, and in the DRC. But these projects are also about improving margin. For example, in Guinea and the DRC, where the money we are investing into our assets will result in sharply lower costs over time as those operations ramp up production. Each of these projects is on track and on schedule. As you can see from this rather crowded slide, here are some list of selected projects that comprise bulk of the increased capital this year. Our project and operating teams have certainly got a lot going on. In the limited time available, I'd like to zoom in to a few of these. Starting with Kibali in the DRC, Mark and his team have done a good job in bringing this asset to the threshold of its ramp up from an already healthy 610,000 ounces that were forecast this year to around 750,000 in 2018. That increase comes with significant improvement in margin, driven by higher grades from underground and a planned reduction in capex, which Mark flagged a few minutes ago, as we put behind the bulk of the heavy expenditure that comes starting an underground mine. In addition, exploration on the site, both near surface and at depth, continue to surprise us on the upside, giving us invaluable flexibility in the coming years. Here is a success story, and when we talk of geopolitical challenges, I'd like to remind everyone that this mine was embargoed in 2006 with governmental interference, no gold going out or imports coming in for 4 months, and it's now a success story within our portfolio. Siguiri has also shaped up to be an exceptional high-margin long-term asset. We have made excellent progress on the combination plant project, which enables us to process both softer oxides and harder transitional and hard rock ore. This project, which includes a new power plant, is on track, and we plan to commission the mill before the end of next year with a ramp-up through 2019. The new plant allows us fully to exploit the exciting potential in this lease area, which we anticipate will help us realize the excellent upside here for many more years to come. For now, Siguiri is a dependable producer at around 300,000 ounces with good free cash flow and potential to go markedly higher whilst maintaining attractive margins. Moving to Australia, Tropicana is a case study in finding, designing, developing an asset fully in-house. It was built on time and on budget, and has met or exceeded every milestone, both operationally and in respect of free cash distributions. After moving out from the initial purple patch in grade in 2015, we developed the next low-cost chapter in this operation's life. For a nominal capital outlay of around $10 million, we've increased the plant capacity to about 30% compared to its original design. By rethinking our waste mining strategy and learning some strip mining lessons from our cousins in coal mining, we have pulled down mining costs by 35% over the past 3 years. This, together with very good drilling program, has helped us consistently to increase our reserve and resource inventory with further grade improvements at depth, providing significant future potential for this asset. The combination of additional ounces, lower mining costs, and better grades will give us a healthy free cash generation for the next few years. It also lays the foundation for us to pursue the feasibility study into the Long Island Life of Mine Extension Program. Turning to Geita. In January, we began self-funding the work to extend the mine life at Geita in Tanzania, transitioning it to being an underground operation as the end of the open pits start to appear on our horizon. We continue to believe that this is where we will start to see the mine's real potential, particularly in the deeper, higher grade resources beneath Nyankanga and the Geita Hill ore bodies. It's worth pointing out that historically, Gator's exploration has been undercooked, and as we address that, the results are surprising us on the upside. In the immediate term, our plans at site are going exactly according to schedule. The power station is substantially complete, and the underground development is proceeding to plan. We see a planned tapering in sustaining capital expenditure next year, whilst this important cash generator still receives a healthy allocation of capital in the year ahead. We can flex this as needed. A quick note on Tanzania, which in recent months, as you are aware, is seeing challenges faced by its extractive sector. There are a few points worth thinking about when considering our activity in Tanzania. First, we are the producers of gold doré only. We are not affected by the ban on export of concentrates or parcels. We have over time built a track record of being the oldest and the largest taxpayer in the mining space, if not the country, with total remittances to the government of around $130 million last year alone. Over the life of the mine, the government has been a beneficiary of more than half of the net value from Gator, which is over $1 billion. We have also developed a strong Tanzanian management team and a crop of local service and equipment providers in the country. And we continue to build on that success to divert as much benefit as we possibly can to Tanzanian citizens. We have nonetheless been subjected to higher royalty and export fees levied under the new set of laws passed in July. Like many other mining companies across Africa, we are battling in Tanzania to get timeous refunds of value-added tax, with a resultant buildup in working capital, penalizing our free cash flows and hurting our valuations. We are working with the authorities, as we have done in the past, to address these issues as soon as possible. Aside from these challenges, Gator is operating as normal, and we continue to see a promising long-term future for this mine for all of its stakeholders. We recognize the uncertainty created by the new legal regime, the impact on current cash flows, and the ongoing challenges faced by our peers is a cause for concern. I can assure you, we'll continue to pursue constructive dialogue with our hosts, whilst ensuring we remain a good guest and investor. We believe these two things together give us the greatest chance for gaining the clarity needed to address the derating that the situation has caused over the course of this year. Moving on to Obuasi, Ghana provides us a good reminder that jurisdictional uncertainty comes and in most cases eventually goes. After a few turbulent years in Ghana, we find ourselves edging closer to a decision on the future of Obuasi, undoubtedly one of the greatest ore bodies available for development. To recap, this around 30 million ounces of high-grade resource with 5.5 million ounces at reserve, all at 8 grams a ton. For the last 3 years, this operation has been on care and maintenance, allowing us time to redesign this mine as a modern, mechanized, and highly productive mining operation. With this clean slate ahead of us, we have completed a feasibility study that addresses the suboptimal mining method and sprawling infrastructure that constrained it in its history. We have the plant, we have the infrastructure, water, access to experienced labor, and a government motivated to support a successful redevelopment. We are working towards reaching an accord with our host on a full range of permissions to provide us with the confidence to restart the project, which at this stage will be a 4,000 ton a day operation, producing 300,000 ounces a year for the first decade, rising to 400,000 ounces thereafter, after the grade kicks up. It can be restarted quickly at industry-leading capital intensity. We'll release the details of the feasibility study metrics once the negotiations with the government are concluded. Assuming successful talks with the government, the project can generate a healthy margin at a gold price of $1,200 an ounce long-term real to meet or exceed our hurdle rate to give us a strong return over life. To conclude, when I stand here before you in 2018, I hope to report resolution on a range of issues that we believe represent positive catalysts for the stock. Obuasi has been a drain for some time, and we aim to have that resolved in a clearly value-accretive manner. I'd also hope that long before that, the understandable unease around our future in Tanzania has been addressed, and that the potential of this important asset is properly reflected in our valuation. Crucially, we will report a lower sustaining capital expenditure bill next year as we get over the hump of our key high-return projects and remove 2 loss-making South African operations. With this restructuring complete, we'll be able to deliver a smaller cash-generative South African business, which represents only 20% of our production. I believe this will all allow us to better daylight excellent performance and potential from our international asset base as we work to improve life and margin. That business currently delivers around 2.8 million ounces at competitive costs, and it's got a very good development pipeline and will receive the bulk of our capital. We all agree that it's significantly undervalued by any metric, and our job is to ensure we realize that value sooner rather than later. Thank you.
Thank you, Venkat. I'm afraid we don't have any time for questions, but please join me in thanking Venkat for the presentation.